Good morning. Welcome to Trading Hour, live from the CNBC-TV18 Motilal Oswal studio. I am Reema, and with me is Vivek, and markets are troubled by the Trump tariffs. We're down close to about 0.5%, 0.6% on the benchmark indices, but there is an intraday recovery. The Nifty, in fact, has pulled back more than 100 points from the day's low of 23,222. Even the mid-cap index is still down about 450 points, but from the day's low, there has been a recovery of close to about 1%. The sectors which are taking a hard knock today are the defense names. The Nifty Defense Index is down more than 5%. PSUs across the board are selling off, and metals is under pressure. We've seen the dollar index surge to nearly levels of 110, and base metal prices are down about 1 to 3% in absolute terms.
Good morning, Reema. Most of the headlines today, while they were expected to be dominated by budget, actually quite a lot of headlines and quite a lot of stock moves are actually being impacted by the kind of tariff moves that we've seen overnight. First set of stocks that are doing quite well are the entire chemical pack. Remember, they stand to benefit from increased tariffs as far as Chinese players are concerned. Have a look at names like PI Industries, UPL, Jubilant Ingreva. All of these stocks doing very well in this session. Like you mentioned, some of the consumer discretionary names continue to do quite well. Look at names like Nyla, Chalet Hotels, VBL, Titan, even a Voltas for that matter, especially in the last 15-20 minutes of trade, has surged to the day's highest point. OMC's significant disappointment in terms of no announcement coming in for LPG under recovery. BPCL, HPCL, IOCL, all of them, HPCL in fact down over 5% in the session today. You spoke about the defense names, but the other set of stocks that are taking a very hard knock today, actually the capital names pack. No incremental capex, so worries in terms of order inflows, how will order books be replenished. Look at the entire pack, L&T, Siemens, Thermax, all of these stocks, even a name like a CG Power today seeing significant selling pressure. And the auto ancillary space, that is the other set of stocks that are seeing quite a bit of a hard knock. Motherson Sumi, Samvardhana Motherson, and Sona BLW. These stocks too under pressure. Again, worries of implications in terms of, remember, they do supply components to quite a few Mexican companies, and these stocks today taking quite a hard knock, Reema. And
not to forget railway stocks. They continue to bleed. Even on Saturday, names like RVNL, Ircon, IRFC were down 7, 8, 9%. And today as well, the correction has continued for these names. RVNL leading the losses with a cut of about 7%. And now from its 52-week high, these stocks are down more than 35%. But let's get to Inox Wind. They reported numbers. To discuss the numbers and way forward, we have Devansh Jain, Executive Director at the Inox GFL Group, joining in. Now, thank you very much, Devansh, for joining in. This is Reema here. First, very quickly, if you could tell us, were there any announcements in the budget which impacts you, positively or negatively?
Look, I think it's a very forward-looking budget, and I think they've been very clear about the national clean manufacturing mission. So I think they've reiterated their commitment to setting up a very large domestic ecosystem for wind turbines, for solar, green hydrogen, electrolyzers. And I think that that shuts out a lot of the noise which has been created over the past couple of weeks, I would say, around the US president's statements around renewable energy. In any case, on the wind side, we're fully domestically focused. So I think we're looking forward to a very, very strong renewable outlay as we move forward.
Devansh, that's right. Quite a few worries, and quite a few of the wind energy stocks actually saw quite a bit of a sell-off on the back of those statements coming in from Trump himself. Well, let's talk about the quarter itself. A very strong quarter for you, especially in terms of operating margins. Can these margins sustain? What is the margin outlook for the rest of FY25? So where will you end FY25 at, and what is the targeted margins for FY26?
Look, yes, I think it's been another strong performance with 190-odd megawatts this quarter. It's been the highest ever EBITDA and PAT for Q3 in the company's history. We've done about 290 EBITDA and 112 PAT. Having said that, I was fairly clear in saying that we maintain our 800 megawatt guidance for this year and our 1200 megawatt guidance for next year. Of course, with the caveat that we could further upgrade it for next year. We had given out a margin guidance, which we had kind of upgraded twice over the course of the past 3 or 4 quarters. And, I don't think we wanted to just keep revising our margin guidance every quarter and just make it a normal affair. So effectively, I think we didn't want to give out any specific indicator for Q4, but I think we are on track to beat our margin for FY25 substantially. And I think it's just common sense for people to be able to kind of extrapolate and see where we are headed for FY25. For FY26, while our current margins, which we've guided for, was 17% plus, with the caveat that we would further upgrade as we move forward. The fact is we're adding a lot of new things to the portfolio. One, we're bringing in, internalizing all our crane requirements, which start ramping up from Q4. We also have a transformer manufacturing line, which is going live in Q4. And I think these, along with some of the newer products, our 4X turbines, which we're launching next year, a lot of these should aid our margins further as we move forward. This is, this is again, besides the fact that within the group, we've now launched Inox Solar, which is only going to lead to more and more opportunity for Inox Wind by partnering and taking part in many of the FDRE and hybrid tenders. Plus, it increases visibility and profitability from our EPC arm and the O&M arm, which is under Inox Wind.
Okay, so you've maintained a couple of guidances that you had given. The other, what we have to keep an eye out for is the fact that when you're talking about execution, 140 megawatts per quarter was the kind of execution you were actually doing. You've maintained your execution guidance for FY26 as FY25 as well as FY26 with an upside risk as far as the margins are concerned of 17%. So going forward, what will be the quarterly run rate we can expect in terms of execution? And number two, is order book accretion a bit of a worry? H1 was slightly muted. How is H2 panning out and how is FY26 panning out?
Look, I think, as I mentioned, in terms of execution, typically it's not a uniform quarter, this business, right? We typically do about 35-40% in H1 and about 60-65% in H2. Yes, it's not lopsided to Q4, as it used to be historically under the feed-in tariff regime. But yes, given it's been a fairly massive ramp-up year for us, where year-on-year our volumes have grown almost 96%, obviously Q4 is fairly large. But given the fact that we've publicly guided for about 1,200 megawatts next year, I think, and looking at where we are headed in Q4, I think that should be a large indicator of what every quarter broadly should look like in FY26. In terms of order bookings, honestly, we've taken in about 1.4 gigawatts of orders over the course of the past couple of months in this financial year. Our current order book is 3.3 gigawatt. And what we've guided for was about 1,200 in FY26 and say 2 gigawatt plus from FY27, looking at the market expanding. Now, the longest order book you can build in this sector is 2 years, because that's the longest lead time you get to execute a project, be it CII, IPPs or PSU tenders. There is no point in us announcing orders which are, over 7-8 years, which are MOUs, which are just LOIs, which no binding agreement or no firmness or not credible parties. I think that is the difference between us and some of the other players in the sector. Having said that, I think I've always said in every, taking in orders has been the least of our worries. We continue to build on our order book. We've just added a couple of orders from Continuum and Hero this year. We've recently got Serentica into the books. We are very selective in terms of the quality of customers we're now adding. I think there's a very strong visibility. There are multiple PSU tenders. Some of them had been delayed, given this was an election year. I think we should see a lot of them coming out also over Q4 and Q1. So honestly, given that we're sold out, if I may say so, over the next 2 years, that's probably the least of our worries.
Completely sold out for the next 2 years? Is that what you said?
Broadly, if that's the terminology, given our current manufacturing capacity, which of course we are ramping up. But yes, in terms of guidances,
there are a lot of PSU tenders upcoming, right, in Q4 and Q1 of FY26. Could you give a ballpark indication of the size? What is your estimated success rate in that you anticipate?
Look, I don't think I'm going to spell out success rates. I think we're selective in the tenders in which we participate. But I would expect over the next 2 quarters, we should see at least 7 to 8 gigawatts of hybrid FDRE tenders being awarded out. And, wind would be about broadly half of that at least.
Okay. All right. Just a quick word, Devansh. There is a lot of concern globally about Trump, and he seems to be targeting renewable energy and particularly wind power in particular. What have you made of those headlines, and will there be any impact on a company like yours?
Look, first and foremost, I think rather than just getting carried away with headline statements, First and foremost, there is no impact of Trump's policies on players like us, which are fully focused on the Indian wind sector. We do not depend on exports. We are not, 100% of our business over the past, I would say 10 years or the past 5 years has all been India. So we have zero impact of Trump's policies on India. Having said that, I would like to reiterate the recent budget maintains heavy focus on RE capacity expansion. There has been enough and more noise around Modi ji's targets, around the clean manufacturing sector, around our net zero targets, and I think all the policy movements have been very positive and reduced this entire uncertainty. For various other parts of the renewable pie. As I mentioned, the wind sector is completely domestic, so we have zero impact. But with respect to other pieces of the pie as well, I think India focusing on its domestic requirements and getting in place what I would call domestic content requirement kind of policies would completely insulate the Indian market to a great extent. Of course, the export markets are a different ballgame, but like I mentioned, in Inox Wind, we are fully focused only on the domestic wind market.
Right. Thank you so much, Devansh, for joining us on an important day just post-budget. Your views on the budget, quarterly performance, as well as the way forward for FY26. Love to have you soon for another quick chat. Let's now slip into a short break. Up next, we'll discuss what's buzzing in the commodity space with Manisha Gupta. Welcome back to Trading Hour. Well, let's now shift focus to the commodity space. Manisha joins in, and today we are focusing on precious metals.
Thank you for that, Vivek. I'm looking at gold prices, which hit an all-time high at $28.17 an ounce on the higher side. 2800. The last time we made an all-time high was last year at around 2,790. So we've done 2,817. It's an all-time high until now. We have seen gold prices gain up for the month of January by nearly 6 to 7%. This has been the best monthly gain since March 2024 that the gold prices have put forth. Well, the gains come in on the back of tariff concerns in the global markets. The expectation is that the 25% tariffs on Canada and Mexico and 10% on China would mean that you could be looking at a slower global economic growth and higher inflation. That means there is safe haven buying coming in for gold. The only reason that the prices have come off those kind of highs is that there is also an expectation, one, of course, the dollar index is gained up, and second, an expectation that the US interest rate cut may not happen at the same pace that the markets were anticipating. So it continues to be quite volatile in case of gold. When you look at the silver prices, well, we are looking at a one-month highs onto this one as well. Interestingly, before these tariffs came into the market, a lot of gold seems to have shifted within US. When you look at gold, there are COMEX reports suggesting that nearly 14 million ounces gold has been taken into the US markets, and around 45 million ounces of silver also has been bought. And this is all in physical. This has been converted from futures into physical and taken into US before all of these tariffs came in. So clearly, a lot of volatile moves and a lot of movement on the physical markets as well when you look at the gold prices. Interestingly, when you look at the Indian markets, we are trading at a $35 per ounce of a discount because there are not too many buyers on the global markets, rather the physical markets right now.
Thank you very much for that. By the way, Asia is stumbling hard and fast now. The Japanese market, Nikkei, is down close to about 3% We should pull up some of the others. The Taiwanese market has a cut of more than 3%. Korean markets have stumbled 2.7%. So there's global uncertainty on account of Trump tariff. He following up on his campaign pledges about imposing tariffs on China, Canada have spooked global equity markets right now. And the Dow futures too is down nearly about 700 points. That too will come up for you on your screen. But our own markets held up by the strength in some of these consumption names, the Bajaj Finance twins, Bharti Airtel. We're still holding above 23,300 in the red, but off the lows. But let's get to the oil marketing companies because these stocks are under severe pressure. HPCL, IOC continuing with the losses from Saturday. Sudarshan joins in for more. Sudarshan.
So oil marketing companies are sharply under pressure, tracking currently down around 3 to 4%. So now this LPG under recovery story has two parts. So first talking in detail about LPG under recoveries. as of 9-month FY25, total under recoveries were of more than rupees 29,000 crore. Now, there was an expectation that in budget of 2025, government would announce the payment for under recovery, and that should be more than rupees 30,000 crore. Now, as of 9-month FY25 for IOC, LPG under recoveries was of rupees more than 14,000 crore. For HPCL, it was of rupees 7,600 crore, and for BPCL, it was of rupees 7,300 crore. Now, budget did not have any mention about LPG under recovery. So now everyone is asking, will there be any payment or there won't be any payment? So oil minister did speak to CNBC-TV18. He said, unlike petrol and diesel, LPG is regulated and government is committed to make the payment for the LPG under recoveries. So it is two parts total about under recoveries. Now the second part is the statement by oil minister saying that payment related to LPG under recoveries will be made. So listen in what exactly he had to say while he was speaking to CNBC-TV18.
Very clearly, we are committed to that. Even when we got it from 28,000 crores, there was an under recovery on LPG. We gave them 22,000 crores. You don't need to make a budgetary provision. We can go to the finance ministry. Otherwise, if somebody behaves like a good corporate citizen, the OMCs, and they've had under recovery, we will compensate them. We are committed to that.
Also, the subsidy for PM Ujjwala has trended down, what we have witnessed so far, despite an increase in the number of beneficiaries. Also, do you feel there is going to be an increase in discretionary spend post the budget?
No, there is going to be enough provision for both LPG and that. Don't worry about it at all. You see, two things are happening. Insofar as natural gas is concerned, prices are coming down. Insofar as LPG, which is a product of a refinery, etc., we will look at that. There's no issue of no anxiety on that score.
All right, on that note, we'll slip into a short break. On the other side, we'll invite the management of Med Plus Health Services to stay in for that discussion. Welcome back. Let's shift our attention, as promised, to Med Plus Health Services. The company recently reported a good set of Q3 numbers. Revenue growth came in at a little more than 8%, but the margin performance was higher than street expectations. To talk about the way forward, Gangadi Madhukar Reddy, MD and CEO at Med Plus Health Services, is with us on the show now. Thank you very much for joining in, Mr. Reddy. So the first question is on your top line. The top line has gone up by 8.3%, but this is a slightly moderated, growth rate compared to what we've seen in the past. What would you attribute that to? Some say it's on account of a rising contribution of the private label generics, which is now more than, I think, about 11.3% in terms of an overall contribution. So what explains that? And two, what can you guide for Q4 near term and even FY26 in terms of a top line?
Sure. You're right, actually. Part of it is explained by the growth of our private label. Our private label, sells at a discount of 50 to 80% discount. So what would otherwise, on a 100 rupee MRP, bill at around 82 or 83 rupees, now bills at around 45 rupees. So that definitely has an impact. Outside of that, this year we've been really focused on getting the, overall private label and a couple of other things right. And we have not, put in as much effort into growing our number of stores. And I would say, given the fact that we have actually grown by 3,000 stores in the last 4 years, we're also seeing a little bit of, I would say, need for making our supply chain slightly more robust. And we're doing that right now. And that, could explain the slightly, I would say, lackluster kind of growth.
So your got that. So your FY26 store count addition guidance was 400 to 450. In the first 9 months, you've done about 205 stores. Now that you're going slow on it, as you said, what could you end the year with in terms of a store count addition for FY25? And will FY26 pick up that slack? Or will this continue in terms of a moderate store count addition?
Yeah. So it looks like we'll most likely end up adding 300 stores net. We've also closed around 70-80 stores. So the actual gross addition is slightly more than that. But net addition, unfortunately, is going to be only 300. And as I said, part of the reason is this, that in some of the states in which we have grown significantly, there are states in which we have over 1,000 stores, in Karnataka and Tamil Nadu and all. We have seen the need to actually put in additional warehouses in the smaller towns to kind of, take out some of the burden on the main warehouses and to also get the product out properly. And so for that reason, till everything gets functional, we actually decided that we'd go a little slow. But I expect almost everything will come online in this quarter and we'll actually be back to normal in the next year as we go forward. I don't want to, commit to a number right now, but, once the AOP is done and all, I fully expect that we'll get back to the usual 600 stores a year kind of number starting next year.
So FY26 onwards, Mr. Reddy, 600 stores a year is what you intend to add. Couple of numbers with the slight moderation in terms of store addition. Will margin profile now incrementally move higher? Can we expect a higher margin profile? So FY25, where will you end EBITDA margins at? And FY26, what is your aspiration?
See, obviously, there are two reasons for the margin profile to go up. One, of course, is, we are adding a lesser number of stores on top of a larger base. We have 4,500. Even if I had 600 stores, that's still going to be a much smaller addition than what we were seeing in the last couple of years, in which we are adding 1,000 on top of 2,000 stores. So that impact is going to be there. So you'll definitely see a slight growth. I can't, give you a number right now. The other thing, of course, is the growing private label. For us, if you look at the volume terms, our private label sales would be around 18 or 19%, only the pharmacy side. And on a net sales basis, it's around 11.6. So what this does is, every 1% growth in net sales increases our margin by around 0.4 to 0.5%. So we definitely see, this is one of the key drivers for, profit growth for us. And we continue to, will continue to push on this lever.
So since that's the thrust of your focus, increasing the contribution of private label from the current 11.6%, how much do you think you will be able to scale it up, say by the end of FY26?
I expect that we could do roughly around 0.5% every quarter. Once you have the initial, early adopters and all, and once you get the initial thing out, growth is not going to be as easy. So I expect we will grow at least 0.5% on net sales every quarter. And that basically means 2% for the year and maybe 1% extra margin.
Mr. Reddy,
So what gets pulled down because of the increased number of stores is a different matter, but the private label alone will at least add that much.
Understood that. Mr. Reddy, one thing we understand about the industry that you're in is that it's extremely competitive by nature. And along with that, we also understand that discounting practices have actually intensified. So keeping that in mind, number one, give us a sense of the current discounting that you're seeing. And number two, is it now a challenge to add stores given the fact that, it's so fragmented? And also, along with that, branded, consciously, are you trying to bring it down even further, given the fact that private could be, priced higher for the end consumer?
No, it's nothing like that. So, as everyone knows, there's zero difference between the branded product and what we sell. They're made in the same factories, at the same quality, and given the fact that we don't have the marketing costs which the other guys have, and it is also sold through our own distribution channel, we're able to give a substantial discount on these. So we just present that to the customer. We tell him, okay, we've got everything which you require in the normal process, and that is at a 20% discount. And our own product is at a discount of anywhere between 50 to 80%. It is for the customer to make a choice. For us, we are completely neutral on that. While we make a slightly higher margin on our private label, we really don't. We still value the label of being a one-stop shop for all medicines. When they come to MedPlus, they get genuine medicines, they get everything they require, and they get it at the best price. So we don't really, avoid selling any branded product. Far from it, we try to increase the fill rate on those products as much as possible.
Got that. Thank you, Mr. Reddy, for joining in. It was a great conversation and wish you all the very best. Get into a break. On the other side, we'll talk market technicals. Soni Patnaik from JM Financial Services joins in with her top trading bets.
Welcome back to Trading Hour. Well, Sony Patnaik from JM Financial Services joins in for a quick technical check of the market. Thank you so much, Sony, for joining us. Give us a sense of how you're looking at markets currently, especially the indices that are seeing quite a bit of a knock today.
Hi, good morning, Vivek and Reema. Thank you for having me on your show. So if we talk about the indices, I think both the indices, Nifty and Bank Nifty, are pretty much range bound. If you look at the Nifty's range, it has to be somewhere between 23,100 on the lower side, which is a good support. On the higher side, 23,500 to 23,550 is the resistance area. So I think as long as it's not holding or breaking either side of the range, further trend could be ruled out for some positional days that one can see. Bank Nifty is quite crucial because Bank Nifty right now is still holding above its support of 49,000. However, for any fresh upside in Bank Nifty, it has to cross 50,200, which is a 200 exponential moving average resistance. So only above that level, we can see fresh upside in Bank Nifty towards 51,500 odd levels. Knowing that the event is lined up for this week, the possibility that Bank Nifty may also remain range bound within a 1,000-point range until the event is played out. So I think both the indices quite range bound. Stock specific action could be the best strategy to go for the next 2 to 3 days.
Sony, you want to tell us the stock-specific trades then, since that's the best strategy?
So, Reema, we'll have a buy and a sell recommendation as a balanced approach. The buy comes in for Bharti Airtel today, which is sustaining above all its major short-term moving average on daily charts. One can buy Bharti Airtel around 1655 odd levels, keeping a stop loss of 1625 and a target of 1700 to 1720 can be seen for the coming days. The second sell recommendation comes in for Canfin Homes, which has broken below its major support levels, below 650 odd levels. So one can sell Canfin Homes in future around 645 to 648 on small rise, keeping a stop loss of 660 and a target of 630 to 620 can be seen.
Thank you so much, Sony, for joining us, giving us a sense of both the market levels to watch out for as well as your individual stock picks. Time now for a short break. We'll get you a slice of our conversation with Neelkanth Mishra of Axis Bank on the Union Budget 2025 on the other side. Stay tuned.
Welcome back. It's one day after the budget and it's time to get your opinion. And this time it's an important one coming in from Neelkanth Mishra, the chief economist at Axis Bank and also the head of global research at Axis Capital. His view is that it's incorrect to say that the government is moving away from infrastructure. The government had limited capacity to spend. They had a discretionary of about 1 lakh crore rupees and they chose to do so on the consumption. So listen in to what he had to say as he weighs his opinion on the consumption versus the capex debate.
Is the interpretation that the government is moving away from infra and focusing on consumption correct? Because it's got implications for markets as such. Go on.
I disagree with that because the limitations on how much the government can do on capex was clear even last year. Remember that out of the 11.1 lakh crores, 9 lakh crores was stuff that the government could control. There was 2.1 lakh crores that they had no control over. So we are hitting the limits on what the government can directly do in terms of capex. And therefore, the guidance from the government was that we will maintain capex as a percentage of GDP year onwards. That the scope for us to do more is now gone. So now they're experimenting with, for example, this 1 lakh crore that they've decided to spend on urban infrastructure, but through a competition mode, so the states need to compete for it. They have to find such avenues so that capex continues, but there is very little more they can do at the central level. So I don't think this is a stepping away from capex.
Absolutely. Neelkanth, in fact, if you could just elaborate on that point, another sort of, statement that's been doing the rounds or calculation or thought process that's doing the rounds is that if you add up capex from the states and the capex that will be done via PSUs, and maybe we're still talking about 20% growth, almost 19 to 20% growth, and not the 10%, which is direct capex, which is in line with nominal GDP. So how would you read into this, the form and format that capex will take from here on?
No, I think those are also very interesting points, but we need to take a step back here and figure out that if gross fixed capital formation as a percentage of GDP in India is 32%, and the central government spending is about 3.7%, or say 3.5%, 3.4%. How much more can it actually contribute? So this is effectively less than 10% of overall investment to GDP in the country. Investment activity in the country is going to be a lot more dependent on how well the real estate cycle turns, how well the power generation cycle turns. And I think this almost obsession with waiting for the government to spend an extra 30,000-40,000 crores, in the larger scheme of things, these are all rounding errors. Remember that the fiscal space for the government was very limited. In fact, in the preview session that we had in your studios, we had discussed this, that, all said and done, there's only about 1 lakh crores, which is less than 0.3% of GDP in FY26, is that the government has discretion on. I think it is unwise to expect the government to be doing everything. And I don't think it needs to be doing everything. If the real estate cycle turns, if the power generation cycle turns, and both seem to be turning, we will not be dependent on the government to drive up, say, the industrial stocks or the earnings for industrial companies.
You're sounding pretty satisfied with regard to what the government has done on the capex spend front. But what about the approach to markets? How would you alter the approach to markets? Given the consumption push, they've maintained capex reasonably. But we also have this threat coming in from Trump's tariffs. So your take on the equity markets from here on, post the recent correction?
Absolutely. I was waiting for someone to say that. So the budget is now in history, right? Budget was largely as expected. There was a 1 lakh crore of tax cut for the middle class. But remember that the government is still shrinking its fiscal deficit. And therefore, the aggregate impact or the demand on aggregate impact on aggregate demand is actually still negative. The Trump tariffs, on the other hand, are going to be, they have triggered something which is very substantial. See, normal wars, especially if they are being fought in other jurisdictions can actually be accretive to earnings, and sometimes they support stock markets. Here, there are political objectives being met through economic damage. So knowing fully well that this will hurt the US economy, and that if there is retaliatory action, it will hurt many parts of the economy. And on top of that, to potentially escalate it to Europe and other parts, I think all of this creates significant uncertainty for the economic forecast. And that, I think, is terrible for markets. So over and above what is happening with the DXY, over and above the 0.8 to 1.5% seems to be the first cut impact on US GDP because of the decisions announced. The reason why the markets are not reacting even stronger is that everyone expects that this is temporary and will be withdrawn. But this adds a very different layer of uncertainty to economic forecast.
All right. But you would agree there is focus on consumption now, right? That you would agree with, Neelkan? And this is after some time putting more money in. And it's not just 1 lakh crore, it's not one time, right? It's recurring. And there is a broader, I don't know whether there's messaging or it's kind of, it had to be done. The move itself is one time, and whether we'll see more moves, etc. So from stock market point of view, consumption, where will this money go according to you? And is there anything investors can do based off this?
Yeah, so that is somewhat easier to quantify. So if you look at the number of people who disclosed income to taxpayers, see, if you're earning that much but you're not paying tax anywhere, you're not impacted. So we have to look at the people who pay taxes. So that this eases our job. The biggest impact is for people disclosing earnings between 12 lakhs and 50 lakhs. The number of people affected, because the last data we have is for FY23, was about 58 lakhs. If you extrapolate it to, say, FY26, maybe about 75 lakh. That's the number of people who will be the biggest beneficiaries of these tax cuts. And most of these people would be in the 90-95 percentile, maybe even higher. The higher ones, maybe the percentage impact will be lower. What is their discretion? What is their incremental demand going to look like? And that's mostly going to be discretionary. So I think that the impact of this directly will be mostly on the discretionary items. So, jewelry, retail, and somewhat, the market was responding rightly to this on Saturday, cars, two-wheelers, etc. So at an aggregate demand level, remember that the deficit is still shrinking. So, and a large part of the space that is being created for these tax cuts are actually also coming from personal income taxes. Absolutely. So whatever you are seeing in terms of better compliance, more people disclosing higher incomes, is now the government has decided to take some bit of that and give it to what was becoming the pillar. So if you compare India's central government's fiscal math, FY19 to FY26, over 7 years, the government has so far seen a very sharp increase in personal income tax to GDP. A large part of that has actually gone into increasing capex because primary deficits are more or less back to where they were in FY19. And so going forward, if you have another lakh crores and there is no ability to spend it directly on the on the issues that you can control, on the areas that you can control as a central government, then you might as well give it back to the taxpayer, which was actually funding a lot of this capex. So that seems to be the political economy equilibrium. I would expect direct impact on the segments which are affected by this, but overall, the questions on whether this increases inflation, whether this increases the current account, I don't think there will be any impact.
Okay, interesting conversation as always, but consumption stocks continue to do very well. ITC Hotels up 5, Swiggy up 4, Nykaa has advanced about 3.5%, Vishal Mega Mart, an affordable retail play, that's advancing nearly about 2.5%, and Varun Beverages is adding on to its gains from Saturday. Get into a break. On the other side, another corporate discussion lined up. Green Lamb Industries, the company reported a soft Q3. Saurabh Mittal joins in next.
Welcome back to Trading Hour. Well, Green Lamb Industries recently reported their Q3 numbers. The company delivered a weak performance in the quarter gone by. Revenue growth was soft while EBITDA declined. Profit after tax halved on a year-on-year basis. To discuss more on this, we are joined by Saurabh Mittal, MD and CEO at Green Lamb Industries, who joins us now. Thank you so much, Mr. Mittal, for joining us now. First up, give us a sense on the outlook as far as FY25 and FY26 revenue targets are concerned. And in this, what will be exposed as a percentage both of sales as well as margins?
So FY25, we were targeting like a 18 to 20% growth earlier. And I think 9 months, we're about close to slightly above 12% growth. So my sense is FY25, we will be in a 12-13% kind of a top line growth, this FY. FY26, we should be, I think, again, back to a 18-20% kind of a growth, and a target for FY26. On domestic to exports, I think the domestic market share will keep going up because several of the new capacities, new products are largely domestic market oriented. I think currently it's about 55% domestic revenue and 45% export revenue. My sense is in the coming year, probably will be 60% domestic and 40% international revenues. While exports will keep growing, but because the two new categories of particle boards and plywood are largely going to be domestic market oriented, the percent shift will happen.
Got that. Saurabh, what according to you are the reasons for the miss versus your expectations? You'll end the year with 12-13% versus your earlier anticipated growth of 18-20%. So what were the headwinds to your mind?
So one is the new plant got delayed from Q3 to Q4, which is the particle board plant. So those revenues got deferred. And I would say the second would be the domestic market offtake has been slower than expected, and even the international growth in Q3 slowed down a bit. So I think just maybe demand situation in both domestic and international markets, and the shift of the production startup of the new plant in Andhra Pradesh, which began on 23rd of Jan. While growth might have slowed down a bit versus our expectation, I would also want to say that we've taken more market share. So we believe we've grown market share in both domestic and the international markets. The new categories of floor and door have started delivering results, and we see a good traction in that segment. The plywood business has also been growing well because we were new in the business, and we've also improved realizations there. So I would say it's a mixed bag. So certain areas we've kind of slipped a bit, mostly demand-led, but versus the market, I think we've taken more market share.
So Saurabh, what's the evidence that you've gained market share? Do we have numbers?
Well, I don't have the numbers off my hand, but if you see records like data of listed companies of H1, so clearly our market share in laminates in both domestic and international has gone up. We do get some data on the international market, but that's a later point of exports from India. So there too we see our growth's been higher than the competition, and we've gained market share.
Okay, Mr. Mittal, one thing we want to understand, while you've gone ahead and moderated your FY25 revenue growth guidance, give us a sense of the volumes you're targeting, because the quarter gone by, there's been volume growth and there's been better realization growth. So FY25 and FY26, give us a sense of volumes that you anticipate in the various segments, and also what will be the realizations that you will be able to garner.
So going category-wise will be hard for volume, but I think we have had volume growth in 9 months across categories, I think, other than the veneer segment. And we've said this earlier, volume in laminates in the core category should grow at about 10-12%, every year. And on the realization front, I think in last quarter and 9 months, I think we've had a lot of pricing discipline. Value mix has been pretty decent. So realizations have been well maintained or slightly have improved. Raw material costs have also been by and large stable. Whatever cost increases happened, we had passed on the increases to the market. So I think from those parameters, things are looking pretty good. We just need to push up a little bit of volume sales to improve our growth and our profitability.
When do you expect the decorative veneers segment to grow?
So if you look at that entire category, the veneer, the flooring and door, they have grown in Q3 and 9 months. And the veneer, the decorative veneer business is still running a slight degrowth on a 9-month basis. So I expect the flooring and veneer to grow well in Q4. The veneer business might be like flattish versus FY24. So Q4 and Q4, we expect some growth coming in. But as a category together, all three products, I think will grow in FY25.
Mr. Mittal, talk to us about both capacity expansion plans at Andhra as well as Gujarat. Both of these plants you expect to increase capacity. When do they come on stream? Any delays over there? And what is the peak performance that we can expect from these new capacities when they come on stream?
So as we talk now, all the new capacities we were building have come into commercial production. So we have no capacities pending to be put to production. While we've said in the past that we have brownfield capacity possibilities in both Gujarat and Andhra Pradesh, they remain the same. On these capacities which have been invested on a near full utilization, I think we should be like a 4,000 crore kind of a revenue, over the next 3 FYs, which is up to FY28. So that's what I can say at this moment.
And a quick word on how we should expect margins of the company to trend going forward?
Well, if the revenues come in, the margins should keep improving. You see gross profit, despite all the challenges, have slightly inched up in Q3. We've been able to maintain gross profit in 9 months versus 9 months. So clearly pricing discipline, value mix, RM costs are stable. So I think we just need to ramp up a little bit on volumes, and I think margins should keep improving as revenues and volumes keep moving up.
Thank you so much, Mr. Mittal, for joining us, giving us a sense of how Q3 panned by. Some moderation as far as FY25 revenue growth is concerned, but a more positive outlook as far as FY26 is concerned. With that, it's a wrap on this edition of Trading Hour. Stay tuned. Halftime Report is up next.